Investing in the stock market is often compared to gambling in a casino. Both involve risk of capital and choice. The gambler and the investor decide how much capital they want to risk. They make choices to minimize their risk and maximize profit. But gambling is not like investing, partly because the risk environments affecting choice are different. A casino is a static place in time. The stock market environment is unpredictable, affected by constantly changing variables.
Investing actually involves more uncertainty than gambling does, because in the world of the casino, it's invariant. There's no time change. No matter what casino you go into, any place in the world, it's going to be the same numbers at the roulette wheel, and they're not open to interpretation. And moreover, you can calculate the outcomes, the odds of achieving any particular outcome at a roulette wheel, whereas you can't in the stock market. In the stock market, you're faced with much greater uncertainty. It's more like being a merchant sailor in the 17th or 18th century, faced with all kinds of unknowns as you set out upon the seas. Pirates, storms, uncertainties of suppliers and creditors. And in the markets, you're also concerned about the changing nature of investor beliefs and interpretation of the numbers, which matter a great deal in markets.
If you sit down at a blackjack table, you have no information about what happened a day, a week, or a year ago at that table. You cannot research its gambling history. Conversely, stock investors and traders have options to prevent a loss of risked capital.
Professional investors have two ways of controlling risk, roughly speaking. There are fundamental analysts who analyze the company's competitive environment, their balance sheets, their marketing plans, their management, and are able to project, therefore, the earnings of a company and calculate the price at which this company should sell. Other professional investors look at the world and the structural changes going on that affect capital markets, such as the rise of China, the Arab Spring affecting oil prices, the Eurozone crisis affecting exports around the world and imports, or the subprime mortgage crisis in the U.S., which had a profound effect on the markets.
One popular risk management strategy is diversification. A diversified stock portfolio contains different asset classes to hopefully minimize potential investment losses. But building a low-risk, diversified portfolio is challenging in a changing, unstable market. A newer asset allocation strategy called downside risk management defines risk differently.
Risk is defined by how much money a client needs in order to fund specific targets, such as retirement, college planning, or any other goals that a client might have. So risk is only the failure to achieve those goals. Any returns above the target rate of return is not risky at all. That's good volatility. Downside risk management starts with the target rate of return that an investor requires in order to meet their financial goals. In downside risk management approach to constructing portfolios, only the risk of failing to achieve that target rate of return is viewed as risky. Any upside is viewed as reward, as positive. Investors know this implicitly, because if you lose 50% of your portfolio, you have to double your money to get back, and it takes a lot of time to get back to where you were.
Registered portfolio managers at Cougar Global Investments in Toronto manage portfolios of high net worth investment clients. They have been employing downside risk methodology since 1993. The methodology protects assets in down markets by avoiding the bear markets, a proprietary investment platform. Globally diversified portfolios are customized to perform in accordance with each client's investment objectives, rather than to one standard diversification platform.
In order to achieve a client's investment objectives, the portfolio manager, using downside risk management, will endeavor to participate in bull markets and avoid bear markets. This means adjusting the asset mix of a client so that sometimes aggressive clients will have no equities, and other times in bull markets, very conservative clients might have all equities. At Cougar Global Investments, we use a forward-looking multiple economic scenario analysis to attach probabilities to the various scenarios that could hit particularly the U.S. economy as the world's largest economy, and still the most important economy for understanding global capital market behavior. One of the scenarios that we do entertain is chaos, or more commonly known as black swans. These are low probability, high impact events such as the collapse of the subprime market in 2007, 2008, which in turn precipitated a global financial crisis. Through the end of 2007, we had our clients about 80% in equities, but there were increasing stresses evident in the financial system, which we were aware of through our analysis, and we pulled clients out of equities entirely ahead of the bulk of the crisis in 2008. These are cash, bonds, and then later adding gold for defensive purposes. By protecting on the downside, we could better achieve their compound growth goals. Because we could, of course, not know that Bear Stearns was going to go under, or that Lehman Brothers was going to go under, or that AIG would have to be rescued, or Merrill Lynch would have to be rescued, or even Goldman Sachs had to be rescued. All we had to know was that there were stresses in the financial system that were so severe that something might happen that would be very ugly. And so we took our clients out of the markets in early 2008.
Tossing the dice for a price may be an entertaining high-risk gamble, but investing with a solid strategy may increase the odds of hitting your goals. For more information, call 800-387-3779 and visit cougarglobal.com.